Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Today, I'm joined by Jamison Smith. We are talking about different business owner structures. So sole prop, partnership LLCs, S Corps, C Corps, we're going to break down. If you're a current business owner, is it worth switching what kind of entity that you are? And if you're starting a business, what's most appropriate. So we're going to break down the pros and cons. So Jamison, let's start with the sole prop. This is the easiest one. Walk us through the pros and cons.
Yeah, simplest structure. This is if you're, single owner. Usually easy or best for smaller businesses. You're a freelancer, you're doing some contracting work. Some of the pros, very easy to set up. There's no formal registration. You don't need an EIN number. It just gets reported on your Schedule C of your tax return. It's pass-through taxation, so everything just flows to your tax return. There's no corporate taxes or anything. Very low administration, meaning there's no EIN number, no separate tax return, nothing like that. Some of the downsides, you have unlimited personal liability. So the owner is personally responsible for all debts and lawsuits since it's passing through to your, personal tax return. It's not its own entity. Can be harder to raise money if you're trying to go to a bank or an investor. They want structured entities generally. And then, you pay self-employment taxes. So, we'll talk about this in an S Corp. There's a way to avoid some of that. But basically, you're paying federal, state, and then Social Security, Medicare taxes, and then local taxes.
And those Social Security and Medicare taxes you're paying twice because you're paying the employee side and the employer side. So, that could be 15.3% all in up to the Social Security tax wage base. Which what is that for 2025?
175.
It is 176,100. So that's a pretty hefty tax, 15.3% on the first 176, and then Social Security 6.2 times 2, so 12.4. So that's another 2.9 on that you're paying anything above that 176. That can be a pretty hefty. A sole prop can have a lot of liability, plus it can be pretty hefty tax-wise, federal, state, local. But those FICA taxes can really get you and bite you. Well, real quick before, so who would a sole prop make sense for?
A doctor that has some 1099 consulting income, or anyone that's doing any type of contracting work. Maybe you're an attorney and you're doing some contracting legal work on the side. I don't know.
Those are good examples. I would say, so one pro tip for if you're a sole prop, at least establish an LLC that's single member. This doesn't change anything from a tax perspective. A sole prop and a single member LLC are going to work the exact same way from a tax perspective. You're going to hit with all the taxes you just described. However, it's going to release some of the liability, a lot of the liability that you just described as well. So if you're a sole prop, if you're a doctor doing, legal work on the side, medical malpractice review, at least establish an LLC that you receive those payments through and that you're operating outside of your day job, your W-2, through the LLC. Not going to help you tax-wise, but some of these other, structures that we're about to talk about do come up with some costs. So, there is a break-even point. If you have to have some meaningful income for it to make sense time-wise, money-wise, for example, to go into an S Corp, especially with all the creative, tax write-offs with a single-member LLC. You can structure a 401k through there. You can structure a cash balance pension plan. You can add your kids on payroll. You can, deduct car expenses. You can have a home office. There's a lot of depreciation. There's lots of things you can do to eliminate a lot of the income. And so what you're paying taxes on could be a lot less if you have those write-off opportunities. So, okay, well, number two would be an LLC, but let's specifically focus on a multi-member LLC, and let's just use partnership LLC as an example of how this works. So pros and cons, break it down for us.
Pros, you have the limited liability protection. You're not personally liable for business debts. Pass-through taxation. So again, profits and losses flow to your personal tax return still, meaning really the difference is a C Corp has its own corporate tax rate. So you avoid that. Flexible management, meaning you can kind of pick and choose, how you're distributing profits, and you don't have to have a formal like board or officers. It doesn't have to be as structured. And then some of the downsides, again, the self-employment tax that we already talked about. There's some administrative cost. You have to issue K-1s. You have to have a corporate, the business tax return. And then, basically administrative and taxes are a little bit more complex.
Absolutely. So from a taxation perspective that you're going to get taxed as it goes on form 1065 for partnership, that each member that has equity inside the company is going to get their K-1. You still will have the self-employment tax unless you elect for an S corporation. And then Pennsylvania state tax, local tax, etc. So this is best for, multiple owned businesses that have multiple owners that want flexibility, that pass through taxation. And it does give a lot of flexibility to distribution. So for example, an S corporation, if you're just to use a simple math, if you have two partners, one's 60%, one's 40%, all profits or distributions have to go out. If 100 grand goes out of the business, 60 grand has to go to the 60% owner, 40 grand has to go to the 40% owner. And a partnership, let's say the 40% owner did a ton more work. You could take 90,000 of that 100 and give it to the 40% owner, 10,000 and give it to the 60% owner. So there's total flexibility is from a distribution schedule in a partnership, where the S Corp is going to be exactly rigid based upon the percentage of equity owned. Now, the way around that with an S Corp would be you just, bonus, but then the bonuses become subject to the FICA taxes. The whole purpose of the S Corp is to avoid the FICA taxes. So if you want the flexibility, you're going to end up paying the same or more in taxes.
One thing, if you're owning real estate, don't do it in an S Corp, do it in an LLC or partnership.
Why is that?
If you're going to hold the real estate long term, and I'm going to mess this up, but there's some tax benefits to the basis in the S Corp, and when you sell it, if you sell it,
you're going to pay all the taxes all at once.
Yeah, and with the S Corp in real estate, you're going to pay the FICA taxes, whereas if you have a partnership and it's not active income, you avoid those.
Yeah, we did a podcast. There's huge differences. The real estate investor, if you're active versus passive, active being better in the event that you can offset W-2 wages and your active income, passive, being better for what you just described. Not as beneficial to offset. You can offset active income, but if you have lots of other passive income, the two offset each other one for one. Passive losses will offset passive gains. So, okay. Well, let's hit on S Corps and then C Corps last. So S Corps, an LLC can opt as an S Corp, or you could just do an S Corp outright. The pros, there's limited liabilities. You do avoid double taxation like you'd have in a C Corp. Only salaries are subject to Social Security and Medicare taxes. So for example, if you had a business, $500,000 of profit, an S Corp, you could do $100,000 as a W-2, $400,000 as a distribution. That $400,000 would avoid, Social Security taxes. You'd avoid Medicare taxes as well. So there is a reasonable. If you get audited by the IRS, you need to make sure that salary is reasonable. So if you're a doctor that would be normally making $500,000 a year, you can't pay yourself a salary of $100,000. You have to do something reasonable on average. Maybe it's $300,000. If you're only distributing $200,000, you have to realize, okay, I've already capped out my Social Security. So the big chunk of that Medicare or that FICA tax, the 12.4%, I'm not saving anything. I'm just saving 2.9%. So 2.9% of the $200,000 in that example will be $5,800. So I'm saving $5,800 being an S Corp over a, just regular LLC. What is my tax fees? I have to now run payroll as an S Corp. I have tax fees. I have to keep a balance sheet. Are all of those things worth a $5,800 tax savings? And so we see a lot of groupthink in S Corp. So, for example, one doctor opens up an S Corp, like the whole practice, all the private practice physicians will do it. not a huge difference if you're doing all the tax strategies you should be doing, a 401k, a pension plan, depreciation, kids on payroll if they're working for your business. You're actually, in a lot of cases, better off just being an LLC than an S corp net of your time, tax, and it's a lot more simple because you don't need to run payroll. Everything will run through a Schedule C versus needing a separate business tax return. It can just flow through your personal tax return on a Schedule C. So a lot more simplicity in LLC. So at S corp, we see it a lot for single-owned business owners. But in general speaking, I would say you have to have a benefit of, let's say, 15,000 plus of tax savings for it to make sense to add that level of complexity into your life, if you're making $500,000 a year.
Yeah, and harder for like a professional service like a doctor or an attorney, because like you said, you have to pay yourself a reasonable salary. But if you own I don't know, what's a good example, like a solar company, and you can pay yourself a salary of $100,000 for running the business, there's no there may not be the IRS. It's very easy for them to say what a doctor's salary should be.
Yep.
If you're a cardiologist and you're paying yourself $100,000, they're going to just look at what other cardiologists make, and that's not reasonable. But if you're in a business outside of that, with that solar example, you can get away with a lower salary generally, and then have everything else flow through the S dividend.
Absolutely. Okay, for taxes, the profits all pass through the shareholders. Self-employment tax on salaries, not distributions. Pennsylvania tax would still hit. Local tax in certain states would still hit. And you do need to, in Pennsylvania, you need to file a PA corporate return, RCT 101, as well. So remember, there's that extra level of complexity. So generally speaking, S corps are, significant profits, but you want to minimize that self-employment tax. Now, again, the lower you take your W-2 to save those FICA taxes, the lower your ability is to put into a 401k or pension plan, because those are all based upon a W-2 versus if you're an LLC, the IRS will let you look for a 401k. You can, the 401k calculations work on the first 345,000 of your earnings. So typically, as long as you show 345, in an LLC, you're going to show everything versus an S corp. It's your choice on how much you show as a W-2. But if you lower that to 100, okay, great. Now we're saving maybe 10, 15, 20 grand, but now we're losing 50 grand of what we get back in a tax deduction from setting up a 401k, maxing it out fully, a cash balance pension plan, et cetera. So depending on your overall goals, again, I think S corps are becoming less and less favorable in the context of someone that's implementing all these other tax strategies. If you're just paying yourself and want to minimize taxes and not doing any retirement savings, not doing any other advanced strategies, then sure, an S corp could make sense. You have to have a good CPA, bookkeeper, et cetera, to make sure you're hitting everything. So, okay, last but not least, C corporations. So really, a C corporation for small business, medium business, something that's not publicly traded, small business owners generally wouldn't see a C corp, with the exception of if you are within 5 to 10 years of selling your business. A C corp, it would be an absolute no-brainer based upon a rule 1202 QSBS, where you can exclude up to $10 million. Or 10x your original investment, your basis, tax-free and capital gains. So at that point right now, $10 million, the highest tax rate of capital gains would be a $2.38 million federal tax savings. So this is basically the sole reason our listener base would want to consider a C corp. Someone that has a 20, 30, 40-year runway, a small business owner, the tech kid, 25 years old, that's blowing something up. They have a 25-year runway. You'd want to be an S corp or an LLC. But for someone that's 5 years within, we just recorded a podcast on the QSPS, so please reference that. But that'd be the main reason why you want to do a C corp. So with that being said, Jameson, give us the pros and cons just in general of the C corp, with the QSBS obviously being the big pro.
Yeah, limited liability protections is the strongest legal protection for owners. Basically, if you got sued, they're suing the company, not you as a person. Unlimited growth potential, so you can have unlimited amount of shareholders, issue multiple stock classes. It's much more attractive if you're raising money for investors. Lower self-employment taxes, because if you take a W-2 out, if you're active in the business, you'll pay all those taxes. But if you're not, the profits of the business pay a corporate tax rate, which is currently 21%. But then anything that you take out gets taxed at the dividend rate 0 to 20%. So you would avoid those self-employment taxes. But again, you're kind of getting double taxed with the corporate tax rate. And then some of the downsides, double taxation. Like I said, you pay the corporate tax rate plus whatever you take out, you pay taxes on. Complex and expensive. You have to have a board of directors, annual meetings. There has to be more like structure within the entity. And then this is important in the state of Pennsylvania. It's one of the highest C Corp tax rates. I think it's like 8 point something %. So, instead of a normal, if you have an S Corp and you're paying 3.07 on a state level, or an LLC partnership, you're paying 3.07, this you can pay 8%. So you're paying higher state taxes in the state of Pennsylvania. And that's obviously state specific depending on what state you're in.
Awesome. Well, that's a general overview of the 4 business structures. We covered sole prop, LLCs, partnerships specifically, S Corps, and then C Corps. But feel free to reach out if you have any questions. If you're a business owner that's planning on selling, if you're a business owner that's planning on evaluating whether you're in the right business structure and you need to convert, there's rules. If you're converting to an S or out of an S, there's certain rules that you have to follow. And then if you're starting a new business, or if you're a doctor, a high income earner that has some side business, and you're wondering what to do with that, how to structure that side business, we're happy to help. Feel free to reach out with any questions. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.